I think 2025 will be the year that something breaks. I think derivatives are going to blow up. I think it's game over. I mean, the average person will say the average person on the right believes that Trump is going to come in and fix everything. It's not fixable. It's mathematically not fixable. I think 2025 is going to be the year that something blows up. It spreads. Markets collapse, and ultimately will be closed. I think we will have a closure of markets worldwide at some point, and that will usher in the first of, I think, at least two resets.
Bill Holter, a financial commentator and precious metals expert, warns of an impending financial reset due to unsustainable debt levels and systemic economic issues. He believes that traditional fiat currencies are at risk of devaluation or collapse, making tangible assets like gold and silver crucial for preserving wealth. Holter emphasizes that gold and silver, being physical assets, cannot default and thus serve as reliable stores of value during financial upheavals. He suggests that as confidence in fiat currencies erodes, the demand for gold and silver will rise, potentially leading to significant increases in their prices. Holter has consistently expressed deep concerns about the escalating U.S. debt levels. He emphasizes that the national debt, which has surpassed $36 trillion, coupled with over $200 trillion in unfunded liabilities, is unsustainable and poses a significant threat to the financial system. Holter argues that the government's reliance on deficit spending and the Federal Reserve's monetary policies are merely delaying an inevitable financial crisis. He warns that the increasing debt service costs, which have already exceeded $1 trillion annually and are projected to rise further, will eventually become unmanageable. In his view, this trajectory could lead to a loss of confidence in the U.S. dollar, prompting foreign nations to seek alternatives for international trade, such as gold or other currencies. Holter suggests that individuals should consider holding physical gold and silver as a hedge against potential currency devaluation and financial instability. In a recent interview with Metals and Miners, Holter warns that this global financial reset could begin as early as 2025, necessitating a complete revaluation of the financial markets and forcing investors to seek protection in safe haven assets. We'll be sharing clips from Bill Holter's insightful interview. Be sure to watch until the end, like and share this video, and subscribe to our channel. Don't forget to hit the notification bell for updates on more valuable content. Thanks for watching, and enjoy the video.
This year, we're going to pay 1.5 trillion in interest alone. The debt is now 36 trillion. It only took 4 months for another trillion to be added on. The month of October and November, I think the number was something like a $600+ billion deficit. I think 2025 is going to be the year that something blows up, it spreads, markets collapse, and ultimately will be closed. I think we will have a closure of markets worldwide at some point, and that will usher in the first of, I think, at least two resets.
When you say reset, can you get into that a little bit?
Prices are skewed right now. I mean, if you look at the price of labor, you look at the price of capital, you look at the price of commodities, they're malpriced. They're not priced right. I mean, just look at silver versus gold, 85 to 1. That's way wrong. Look at interest rates. How is it possible that the United States pays the interest rates that it is currently paying with the risk of default, and default being defined as either non-payment or just printing the money and debasing the dollar to pay it? So I think, and I mean, look at the stock market. Stock markets are at levels not seen before on valuation levels. So I think there's going to be a reset, and prices. When I say reset, I'm talking about pricing. Well, first off, understand why we had QE. We had QE because the financial markets, and thus the real economy, because if markets are, get wiped out, the real economy will definitely turn negative. But the financial markets were held up with QE stands for quantitative easing, but the E, it should be QEE. the word emergency should be in there, because that's where QE came from originally, was because markets looked like they were going to turn around and collapse. And we lived basically from 2008 until 2022 or 23, when it first started raising rates. QE was to support a financial system that could not stand on its own. So just understand that QE, we wouldn't have gotten here without QE. Now, you're talking about a market turn down. We really, I don't think we can have a 15 or 20% market correction without markets actually closing, because that's going to hurt enough derivative positions that go belly up. And once that happens, the problem with that is, if the losers lose so big that they're wiped out, then the winners lose too, because they don't get paid. That's the danger. And you're talking about, the number's probably over $2 quadrillion worth of derivatives. So you're asking me about a market turndown and how severe does it need to be. What I'm telling you is kind of the opposite. It can't be more than 15 or 20%, because if it is, then you wipe out derivative positions. You've got people going upside down, and you'll have a market melt down to the point where the only way to stop it is to pull the plug out of the wall. Why are we seeing all these rate cuts if everything's so good? I mean, we've got strong growth, low inflation, blah, blah, blah. What we're told is all bullshit. And they understand that this thing's turning down. And I think they need to be seen as easing going into 2025, because, like I said, I think they're going to pull the rug in 2025. And I think central banks will say, well, we tried.
Why are central banks buying so much gold, especially if it's an old relic that won't be used in the future financial system?
Again, you did it again with your last sentence. My question was going to be, or my answer was going to be, why? Why are these central banks buying all this gold? I think you've got to go back to the October of 2022 that we talked about earlier, when the 300 billion of Russian treasuries were sequestered. These central banks understand two things. They understand the mathematics of the fiscal situation of the U.S., which is the issuer of the world's reserve currency that they hold on their books as reserves. They understand that there's a super high probability, I'm not going to say risk, super high probability of a massive devaluation in the dollar, which is going to leave a hole in their balance sheets. So they've looked for something, what can we do to offset, if we're going to lose on the dollars, what can we do to gain? Well, gold is obvious. The other thing is, they're looking at, well, if they can do this to Russia, then the U.S. can just cancel out our reserves. So, I think those are the two obvious reasons you've got central bank buying.
Central bank gold accumulation has been a recurring theme for the past few years. The sudden change in the investment strategy of the world's apex banks has caught the world by surprise, particularly with central banks like the People's Bank of China simultaneously dumping U.S. treasuries and loading up on gold. Additionally, central banks are repatriating their gold, bringing their gold reserves home from the United States and the United Kingdom in response to the sanctions leveled against Russia and to mitigate risks associated with fiat currencies and geopolitical tensions. This has been an ongoing trend for several months now. Though authorities in the West try to downplay the importance of this sudden shift in strategy, experts warn that this could indicate a bigger problem. Experts like Holter caution that central banks, with their infinite resources, are the most sophisticated and well-informed investors on the planet. These apex banks also know of impending crises way before they happen, or before other categories of investors become informed about them. As a result, this sudden shift in their strategy should send warning signals to all investors, regardless of the official narrative. Let's get back to the interview.
Well, think about how messed up that is. They took 50 billion of Russian treasuries to use as collateral to take out a $20 billion loan to give to the Ukraine. So if you're Vladimir Putin, they just stole 50 billion of your money, and they gave 20 billion to your opponent to fight you. That is so bad. And they did that right after a week or 2 weeks after the display of the Oreshnik missile, which cannot be stopped. The West has there are no weapons anywhere in the West that can keep up with that. And if you can't catch it, you can't kill it. They can hit London from Moscow within 20 minutes. That's how fast these things are. So from that standpoint, that's an absolute disaster. From a broader standpoint, what about all these other countries in the rest of the world who just watched that happen, that have treasury balances? They've got to be thinking, well, hell, if they could do it to Russia, they sure as hell could do it to us.
Picture a dinner party, Christmas 2029, with two tables. One table is very happy, the other is sad. They're happy and sad because of what they invested in right now, 2024 and early 2025. What do these two tables represent to you in terms of asset classes?
Well, it's tangibles versus, the financialized assets. And I think that the happy table is going to be pretty sparse. Let's say that there's 100 people in the room total. You might have 3 or 4 people at that table. And of the 3 or 4 people, only one bought gold or silver or had gold or silver. The people who are buying gold and silver now will essentially end up, once it burns to the ground, the people who own gold and silver will be literally individual banks, because they'll be the only ones who have money, because money is going to burn. Currencies all across the globe are all fiat, which means they're all debt-based. And I've been on the record for probably 15 years now that the ending of this whole scenario would be a credit/currency crisis. It would start with credit, and currencies would collapse because they're currency backed, or they're debt backed. I believe that the credit markets are going to seize up. And when they seize up, nothing will work. We won't be able to do this interview. There won't be whatever platform you're using. Electricity will be spotty. Water will be spotty. Food in grocery stores will be non-existent. And I say that because how does food get to the store? Look at a loaf of bread. How many uses of credit does a loaf of bread have? Well, more than a dozen uses of credit for one loaf of bread. You've got the silos, you got the farmers, the truckers to the silo truckers again to the production facilities, and then truckers again to your local grocer. None of that's going to work if there's no credit. So that other table, there's not going to be any food on it. Now, by 2029, I would expect things to have started to reboot, and I'm not exactly sure what the system's going to look like, but sometime between now and 2029, that table is going to be empty, and procurement of food is going to be number one on everyone's list every day. People say, oh, you're a doom and gloomer. All I do is talk doom porn. No, this is pure logic. It's pure math. And credit is going to break. Can't tell you when exactly. I do believe it will be this coming year. But once credit does break, your lifestyle, the way everything you've come to know and love is done. My message is just, if you can see this coming and you've been preparing, or you're just starting to prepare, just do the best you can. That's the best you can do. You're definitely going to forget some stuff. Don't beat yourself up, because the best you can do is the best you can do.
Bill Holter emphasizes that gold and silver offer unique security in a world facing mounting financial and systemic risks. Unlike fiat currencies or paper assets, these precious metals have no counterparty risk, meaning their value isn't dependent on institutional solvency or government guarantees. This independence becomes especially appealing during periods of heightened uncertainty, such as the one he believes we are entering. Holter highlights several alarming factors, including the U.S. debt-to-GDP ratio, the increasing fragility of the banking system, and other global economic concerns. At roughly 130%, this level historically signals either prolonged economic stagnation or a looming fiscal crisis. Rising interest rates further exacerbate the cost of servicing debt, intensifying strain on the economy. The financial sector is also showing signs of stress, including shrinking profitability, increased exposure to bad debts, and heightened risks linked to derivatives. Any major credit event could trigger widespread instability, threatening the entire system. Excessive leverage, inflated asset prices, and geopolitical tensions make the broader economic situation precarious. These interconnected issues amplify systemic risks, leaving banks vulnerable to liquidity shortages or cascading confidence crises. Holter's takeaway is clear. In times of instability, minimizing reliance on fiat assets and institutions is vital. Gold and silver serve not only as hedges, but as financial lifeboats in an increasingly fragile system. While predictions of imminent collapse may vary, the vulnerabilities he outlines are undeniable. Holter and other sound money analysts have also frequently raised concerns about the potential introduction of central bank digital currencies, CBDCs, as part of the financial reset. He expresses concerns that CBDCs could lead to increased governmental control over individual finances and the global monetary system. Holter argues that CBDCs, being fully digital and centralized, would allow governments and central banks to track every financial transaction in real time. Unlike physical cash, which offers anonymity, CBDCs could eliminate any semblance of financial privacy. This level of surveillance could enable authorities to monitor and control how individuals spend their money, undermining personal freedoms. CBDCs would make it easier for central banks to implement policies like negative interest rates, where individuals are charged for holding money in their digital wallets. This could erode savings and force people to spend or invest in ways that align with central bank policies rather than their own financial goals. As CBDCs become more prevalent, Holter fears they could marginalize physical assets like cash and precious metals. This could lead to a cashless society where individuals are entirely dependent on digital currencies controlled by central authorities. In this context, he argues that holding physical gold and silver becomes even more important as a means of maintaining financial autonomy and security. Over the past week, gold and silver markets have experienced notable movements influenced by central bank policies and economic indicators. Gold prices have shown modest increases, with spot gold rising approximately 0.1% to $2,650.86 per ounce on December 16, 2024. This upward trend is largely attributed to investor anticipation of the Federal Reserve's policy meeting, where a 25 basis point interest rate cut is widely expected. Such monetary easing typically enhances gold's appeal as a non-yielding asset. Additionally, reports of China resuming gold purchases have provided further support to gold prices. This development, coupled with expectations of the Federal Reserve's interest rate reduction, has contributed to gold's weekly gain of over 2%. Silver has mirrored gold's performance, with spot silver prices experiencing slight fluctuations. On December 16, 2024, spot silver slipped 0.2% to $30.50 per ounce. Despite these minor changes, silver remains sensitive to industrial demand and economic outlooks, which are influenced by central bank policies and global economic indicators. The Federal Reserve's anticipated interest rate cut has been a significant driver for both metals. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold and silver, making them more attractive to investors. Furthermore, geopolitical tensions, such as the situation in Gaza, have added a layer of uncertainty, prompting investors to seek safe haven assets. Do you agree with Bill Holter's perspective on the state of the U.S. economy and the broader financial system? Share your thoughts in the comments below, and don't forget to like this video, subscribe to the channel, and turn on post notifications for similar updates.